Hey, welcome to the live stream. It is July 12th. It's a Saturday. It's the middle of the day. We've had, I guess, about 9, 10 days of trading so far this month, and we've got about 2 weeks left in the month. But it's going to get really, really active next week with a lot of earnings reports coming. So it should be a real interesting week coming up, and it's going to stay interesting for the next couple of months. And the market continues to go higher, and I expect it's going to go higher from this point. And the reason for it is it's up 25% since April 9th. And that type of momentum is catching a lot of retail investors, institutional investors. Everybody wants a piece of the action because they just don't want to be left behind. What I thought I could do on this live stream is a couple of things. I wanted to look at super investors, see what they're up to. I think I learned a lot from looking at their portfolios, seeing how they are trying to outperform the market. I'll stack rank the super investors that I track and show you who's on top of the list. There's a new investor at the very top, and he leapfrogged everyone. I'll show you the positions, the stocks that led to him being number one of all super investors that I'm tracking, and I'm tracking most of the big ones. As you listen, and if you want to have me review a stock, I'd be glad to do it. If you're a member, just put the stock ticker in the chat. I'll take a look at it. We will look at the fundamentals of the stock, fundamentals of the company. We'll see how they're growing their top line revenue. We'll look at cash. We'll look at profitability. We'll look at the desirability of that business and make a decision on whether that's a discounted stock or it's being sold at a premium. And if you're not a member, I encourage you to become a member. It'd be great to have you. But if that's not the right thing for you, but you still want a ticker reviewed on the live stream, I'd be glad to do it. It's just a $5 super chat, and that way it'll be equitable for those that do pay and are members of the channel. That way they don't feel like, hey, I'm paying for something that everybody else gets for free. So hopefully you understand that. But I'm really glad you guys joined. I'll try to make this live stream a valuable time that you're going to be spending with me, and I hope you walk away with a little more insight to make you a better investor going forward. So just a quick intro to me is in case you're new to my channel. I'm a long-term investor. I like finding really good businesses that have a nice discount to their stock currently, buying them at a good price and holding, making money. It's a simple concept, but it's very difficult. As I'm sure if you've been investing for a while, you know that it is difficult. But once you are able to become a successful investor and build the skill and the knowledge and the experience, it just becomes a way for you to make money. I'm having the best year of my investing career, and really the last 10 years, I've made more money, I've accumulated more wealth than the rest of my life. Like, I'm 56. In the last 10 years, things have really accelerated. And I think it's because as an investment compounds and continues to compound on gains and appreciation, so does an investor's journey, knowledge, skill, ability, know-how. And that's one of the things that I would encourage you to consider is rather than being a passive investor and, completely being in ETFs as an example, or completely leaving it up to somebody else to make decisions for your investments, is invest your time and energy so you could become a better investor over time. I've done so, and I'm really glad I did so. So let's take a look at these super investors to get started, and we'll see what they've been up to. I'm going to start with the stack rankings of super investors. And right now, the investor who's at the very top of the food chain, let me make this a little bigger for you guys, is Robert Vinall. And this investor is out of Europe. We're going to take a closer look at Robert Vinall and see how is this guy driving 20.24% rate of return for 2025. This is just year to date. So he's doing great. Show you the investments he's made. Obviously, he's making good investments. He took over the top spot from Tom Lee. And Michael Burry's near the top. A new or I should say an investor that's really made a lot of progress is Carl Icahn, the corporate raider. And this gentleman deserves a lot of respect. I know he could be an investor that um, creates a lot of enemies. He's certainly done that, but he's made some good investments, and I want to take a look at what he's invested in. It's interesting to see his portfolio. David Tepper, he's been solid in 2025. Kathy Wood, she's up, or her portfolio, and this is her biggest portfolio. Same thing with Tom Lee. This is his Granny Shots portfolio, and this is Kathy Wood's biggest fund that she's most famous for. Now, Kathy Wood gets a lot of negative attention. I think a lot of naysayers would like to think that Kathy Wood is, out of her mind and not a good investor and so forth. And I can understand people criticizing any of the investors I have listed, but I think this year, I think a couple of her investments have been spot on. And I'm not a Kathy Wood fan. I don't invest the way she does. I think at times she sounds pretty irrational and she talks about like Tesla and stuff. But I need to pay my respects to an investor that's up 15.73%. I'm up over 20%. It's a really good year for me, but I'm not on this list. I'm not a super investor, so I'm not going to put myself in their category. But I could just say that, hey, Kathy Wood is doing better than a lot of these legends. If you look at one of my favorite investors is Pat Dorsey. He's negative 3%. Manish Pabre, he's a good investor. He's down 13%. David Einhorn, he's really good. These two guys, Pat Dorsey, David Einhorn, they're like geniuses. They're really, really, really smart, and they have decades of experience, decades of success. So again, back to Kathy Wood, she's getting my respect, and I would encourage you to try to learn. Maybe she's got a few things that she's doing that could translate into successful investments for you. Guy Spire is hanging on to a slight gain over the S&P. The S&P is here. This is the cutoff. These are all the institutional super investors that are above the S&P. And we've got some investors below the S&P. And the investors include David Katz. He's not a very well-known investor, but he is a super investor. Howard Marks is a legend. He has been very generous with his knowledge and his philosophy. He's not beating the S&P this year. Ackman, he gets a lot of press, very well known, but I track the portfolio he reports on, to the in his 13F filings, and he's not beating the S&P, and he's lagging all the other investors. Lee Lu is a disciple of Warren Buffett, Charlie Munger. He's barely positive. Warren Buffett, the great Warren Buffett. This is not Berkshire Hathaway stock. This is Warren Buffett stock. And you could see that Apple, which is his biggest holding, is really limiting the performance of his portfolio. Apple's the biggest, part of his portfolio, and it's holding him back. David Einhorn, he's made a few investments that have held him back. And so has Pat Dorsey. Pat Dorsey, again, I really like Pat Dorsey. I recommend his book. I recommended his book to a young investor, and he bought the book. I believe this guy's a freaking awesome super investor. And I would also say that even though 2025 is -3 year to date, you look at 24, 23, he killed it. He was like mid 30% rate of return consecutive years. So Pat Dorsey is a really good investor. Monish, and I got actually one of the things that I like when I look at super investors is I get ideas and I get ideas to make money. And one of my investments right now came out of this guy's portfolio because he's betting on a company that has just been beaten down so bad, but it can't go any further. So I'm buying into that stock, and so far so good. And then the last one is Stan Druckenmiller, and this guy here is a really successful investor. He manages a family fund, meaning he's wealthy enough where he's just managing his own money and the money of his family. And he's not having a good year at all, minus 16%. So let's take a look at Robert Vinall to get started. We'll see what this guy's doing that's working. Let me say hello to a few people. And one of my good buddies online is Trader Pratt. Hold on a second. It's not that hard to beat the SPY. Using SPY as a benchmark is a joke. All right. Thank you for your opinion, sir. Revere Asset Management has great content. All right. Thanks for the tip there. I am going to check out Revere Asset Management and take a look. Who's the investor behind Revere? Is it like a name, like a Bill Ackman or something like that? Looks like Nathan is on. Good to see you, Nathan. Hopefully you are doing well. Zubio, I bought a good amount of UDMY. UDMY. That rings a bell. We'll take a peek at that. I just want to know what that is. Shadow Guy. So you're going to meet. That's right. He told me that he has a meeting now. I'd love to go. I think he said he was going to be in Switzerland, the meeting, but it's going to be in the winter. And I'm not a big skier. I skied when I was in my 20s, tiny bit when I was in my 30s. I'm 56. I don't ski anymore. My wife doesn't. She likes the mountains. I love the mountains, but I'm more of a mountain biker, hiker. And skiing's not in my, the reason why I don't like skiing is you go to a cold weather climate, and I'm kind of a thin-skinned Southern California resident, as you know. I like going like somewhere like Cancun or Hawaii or somewhere like warm. And going to Switzerland in the winter might be a tough sell. My wife and I would love to go to Switzerland, but in the summertime. We'd love to go in the summertime. We love the mountains in the summer. So I kind of regret that I'm not going to that meeting with you, but maybe I'll change my mind. That's really cool that you're going to go see him, by the way. You're going to meet him. Let's take a look at his portfolio and see what this guy's doing that's working. So first, let's take a look at his portfolio that I just updated. So this is the portfolio sheet that I track, and I'm able to establish the rate of return for Vinall. Let me kind of squeeze this into, I'm going to reduce a couple of things out of here that aren't really that valuable so I can show you all the fields. All right, we know these sectors. That's kind of interesting. I'll leave that there. And I'll make this a little smaller. Hopefully it's not too small. Make this a little smaller. All right, I think that all fits nice and neatly. All right, perfect. So I took all his data, and FYI, he updated his data for 13F reports like a couple of days ago, which is kind of cool because I'm looking at it as of the end of the second quarter. So very fresh data that we're looking for Vinall. His number one winner has been Carvana. So Mr. Vinall, I tip my hat as they would do in baseball, sign of respect. Look at this rate of return. And in the first half of the year, he earned 65.7% on Carvana. Big position, big bet. made $73 million for his investors. Nicely done, sir. And just in a couple of days, just in this, in essence, since June 30th to now, that investment continues to make money. Made $2 million just in the days that we traded in July. So that's been the primary ingredient to Vinall's success is Carvana. Now Carvana, I mean, that one took a lot of guts, man, because I like the Carvana story. This is a company that's out of Arizona, and things were not looking good. Coming out of during COVID, car scarcity created really high car prices. Carvana bought a bunch of cars and then they couldn't sell them, and they had a cash problem. They got lots of cars, but they don't have any cash. So the market said, okay, we think you're going to go bankrupt, and they sold Carvana off. 98% of a Carvana stock, stock price disappeared. Holy smokes, man. So that was a stock the market said, we think you're in that much trouble that you're going to go bankrupt. And then the stock, they didn't go bankrupt, and the stock's gone up 8,385%. Oh, beautiful. Now, for investors to jump into a stock like this, mad respect. It's also really risky. Obviously, the market took it down because they were in trouble, and they were in trouble. They had a lot of cars. Those cars lost a lot of value because in the peak of scarcity, you may have a truck, let's say a Toyota Tacoma truck, which is a very popular car or truck. And during the scarcity of cars, say a 2018 Toyota Tacoma, a couple of years old, that was like selling for $40,000. And then after, just a year or two later, that same truck was selling for $20,000. So that unit lost about 50% of its value very quickly. And Carvana was stuck with a lot of cars, and that's what drove a lot of losses. More importantly, they couldn't get rid of these things. They couldn't convert them into cash, even at a loss. So they had really, really tight cash problems. They were able to battle through and get to the other side on it, and now the stock's doing better. In the last year, Carvana has seen its volatility, but this isn't the right stock for me. It doesn't fit my profile. I have mad respect for this investor that made so much money on Carvana, but Carvana doesn't make enough money. I like businesses that make a lot of profit, a lot of cash flow, and I feel like, hey, that business is going to be much bigger in 5 years, much more valuable, just going to compound my wealth. It's just going to keep going higher and higher and higher. I just don't feel like that about Carvana. I feel like they're in a very competitive market. They're competing against used car dealerships. They're competing against a couple of other companies that do what they're doing. So now we have another threat to Carvana would be you have like robo-taxi. I have a younger son. He's 20 years old, and he's pretty bright kid, and he really doesn't want to own a car. He'd rather just Uber everywhere. And I think there's a good part of our population that might join my son in that way of living, which is why buy a car? So those are other forces that are going to be against Carvana. So back to Vinall. So his number one money maker was Carvana. I guess his number two is Meta. Nicely done with Meta. That is a really, really good stock for him. Overall, he's made 22.54% rate of return in the first year to date, and that's equated to $18.8 million in gains for his investors. Very nicely done. That's a stock that I think is just going to keep going up. Looks like his third biggest moneymaker is Credit Acceptance Corporation. Never heard of them. His biggest money loser is Wix. And Wix is a technology company. They do like website software. And if you wanted to have a website for your business, you go on Wix and you can create a really nice website. I've looked at that business over the years and it just never has enough value. I think there's other software companies that I preferred, never invested in Wix. I always thought it just doesn't have the right fundamentals. It doesn't drive enough cash flow. It doesn't drive enough profit. It doesn't grow very quickly either. So it's the one that's been the fly in the ointment, but overall he's doing well. Coming down, he's playing in China a little bit. Pinduoduo up 8%. Interactive Brokers. This one I've seen other investors on this live, or I should say on other live streams that I've held. This stock's come up, and I'm a big Robinhood stockholder. I also own Futu, and those are my plays in this space. But boy, Interactive Brokers is doing really well this year, up 31%. And Vinall is making money, made almost $3 million for his investors on that one stock. Again, another Chinese play here, Yum over in China. And here's a new position. He decided to start investing in Google, Alphabet. And I don't know if you had a chance to see a video I released this morning, but Google is one of 4 stocks that I believe are the best stocks to buy right now. Google is just really, it's incredible to see the market doubt Google. And I've seen it with other businesses like Meta there was a lot of doubt around Meta. There's been doubt around other businesses. And it's one thing if it's true or if it has a lot of fact behind it. But I mean, Meta is almost counted out, and they have to prove that they need to be counted in. And the businesses that automatically people are thinking, well, they're going to lose the browser business, the Chrome business. That's going to be hard to imagine because switching browsers is tough. I'm sure you guys use Chrome, some of you. It saves a lot of your preferences, a lot of your passwords. It's so good, Microsoft copies it. Microsoft's like a big Google copier. They copy exactly what Chrome does. And Chrome is really optimized for Android phones as well. So replacing Chrome, and I think there's a story out there that a combination of OpenAI and I think Perplexity, they're going to create a browser. Well, good luck with that. It takes like a decade to make your browser successful, but I'm sure you can do it if you can throw, I don't know, $5 billion at it, which is what Google's had to do. And these businesses that Google has, they're just really good and they were built over time. The YouTube business, phenomenal business. No one's going to replace that. It's all grassroots, created content by communities. It's just a really, really good business. And I can go on and on about Google, but it's good to see that this really accomplished investor is in Google. It's like, all right, cool. And this is a new position. He just reported this position on July 8th. He said, hey, I'm a Google investor. And it makes one more super investor that believes Google has a really strong path forward. He put $5.7 million into Google. We'll see how that does. So far, so good. He's owned it just, less than a month, and he's up 2% on Google. The other companies he owns, I'll note that he owns Microsoft. Really smart move. Paycom, he's done okay with that. Deere, look at that. He's made 21% on Deere. Nicely done, sir. So the number one investor, top of the stack, Robert Vinall. Nicely done, sir. Let's go into his website. This is the guy. It's the gentleman with the red, orange, and blue striped shirt. And I listened to some of his speeches. He's a really down-to-earth guy. And I really like his humbleness. He speaks to his investors as pretty much, a very respectful way. and he's out to make money for his investors. I think he's very approachable. He's not an arrogant, kind of, hey, I know it all kind of person. He's actually down to earth. And I believe this is a partnership. These are the two guys that run um, RV Capital. And looking at the fund itself, this is the fund. This is the 13F information that was sent over. I got into it. And just a couple of things that I wanted to kind of point out. I kind of showed you the whole fund. You are paying an administrative fee. So he's up 20%. So, it'd be like he's up 19%. But I don't put that into this, super investor um, performance because I just want to keep it as simple as possible. Here's his top holdings. We kind of went over that. And the other thing is he's an investor who's located in Europe, but most of his stocks are in the United States, and then 13% in the Netherlands, Cayman Islands, those are international companies, 7% in Israel, 6% in Norway. So that's Robert Vinall. Nicely done, sir. And congratulations if you're invested with Vinall. But lessons learned. Let's kind of recap lessons learned. So if you really know an industry, and you really, really know an industry, then you can kind of predict, like, hey, this business is going to come back. Hey, this business is going to make it. And there's a lot of doubt in that business. That's where you can make a lot of money, just like he did with Carvana. Again, Carvana is not my type of business. I don't like automotive manufacturers and retailers of automotive cars. I'm like, there's better ways for me to make money. But this business here, it was caught up in a really bad situation. And those who believed that the company was going to make it out of that trouble were really rewarded. So that's one of the lessons is try to be really good at certain industries. Have a knowledge advantage. If you really know that industry better than most investors, you'll know where the puck is going with that industry. You can also determine, hey, that business, they're done. They're not going to be around. Or you might say, no, that business is actually going to come back. It's not my favorite kind of business, but it's so discounted, I can make some money. So that might be the play. Another lesson learned is he is in some household names. There's Meta. He got into Alphabet. He owns Microsoft. So this super investor knows that, hey, this is where value is going to be held, and this is where value, or I should say capital, is going to grow, is in companies like Meta, Google, Alphabet, Microsoft, big tech. He's also going into some smaller caps. Wix is a smaller cap. He's in China, so he's got a mix of things. He doesn't have a huge list of stocks. I'm doubling up on a couple of stocks. I think Carvana's doubled up. That's the only one. So I think all in all, he has 11 stocks that he owns. So he really concentrates his investment into a few stocks. So Robert Vinall did a really, really nice job. I'll keep tracking him throughout the year, and we'll see if he stays on top. But I'm sure his investors are really liking the fact that, hey, this is really good performance. One of the things that drove me to become a very active retail investor is that, like you guys, I worked really hard for my money. I'm 56. I've been working for more than 30 years professionally. And for some years and, long periods of time, I was really focused on, advancing my education. I have a master's in business. I'm professionally employed in the technology industry. I really focused on just becoming the most valuable person in that industry and expanding my pay. That's what I was focused on. So I didn't have a ton of time to learn to become an individual investor up until maybe 20 years ago, 15 years ago is when I really started to get super serious about it. And at that time, I would invest in some of these funds. And it was somewhat frustrating to see why is the market higher and this fund isn't performing up to the S&P and then I'm paying that particular fund manager. It seems like there's not a big incentive for those guys to do well, or there's no accountability to the lack of performance, and they still get the management fee. And one of the reasons I look at these super investors is to see, hey, which ones are good and which ones are more name than they are performance. Like for example, I'm going to pick on Bill Ackman. This guy gets so much credit. He should be like leading the pack every year, but that's not the case. Follow him year after year, and he's not performing at the top. He'll always talk about like some of his legendary investments he's made like 10 years ago. It's like, no, investors, at least my approach is I want to look forward. I want to know how I can make money for the remainder of 2025 or 2026. So one of the reasons that I became a really active investor is I just didn't see how the managers of mutual funds or wealth advisors, which I hired 15 years ago, 20 years ago, they just were trying to convince me that having modest gains was acceptable and that paying these people a significant amount, if you consider, if you're saving up a lot of money, that 1% really adds up. In my case, it's like paying somebody $20,000 to $40,000 a year. So I didn't really feel comfortable that, hey, I'm making enough money using these wealth managers or fund managers, and I just don't see the accountability. So I started to learn and I do it on my own. And I'm really glad I did so because I've done far better. And I think I'm more empowered to even do better in the future. All right, so let me answer some comments, and then we're going to keep going down this list. Saeed, good to see you, man. Okay, I found it. One of his top stocks is missing from the 4F. Send it on this Discord. Perfect. Yeah, please send it to me. If he didn't report it on the 13F, which is possible because 13F, I think, involves stocks that are listed on the New York Stock Exchange. You have to report it. But let's say he was invested in a stock that trades in just the India stock market. He wouldn't have to report it. So it could be, an add-on. Thank you for bringing that up. Yeah, do you know which fund that tracks? I think it is the business owner fund, um, but I'd have to look at the 13F filing. I think I have it here. Let's see. So Robert Vinall. So I don't know if I can answer that question. It's the way he reports it to the SEC. He has a total of 12 stocks. I think he only has one fund. So I think it makes it easy. So thanks for the question on that. Hopefully that gives you the information. Philippe Pais. Yeah, I can review stocks, and it looks like you're interested in RCAT. Would love to know your thoughts. Yeah, I can take a peek at it. If you want me to do a full review of it, it's a $5 super chat, but I can kind of glance at it. We'll take a peek, and then you tell me if you want me to go deep dive. It's a $5 super chat to do that. Think about that, and I'll give you a minute to review it. And all right, so before I jump into the next investor, and we're gonna go down this list a little. We're gonna go past Tom Lee quickly, and then I wanted to get down to Carl Icahn. I think somebody wanted to take a look at UDMY. UDMY is Demi. Okay, so these guys is a learning company that operates a marketplace platform for learning skills in North America, Europe, Middle East, Africa, Latin America. Okay. Okay. And Learning during COVID, these learning platforms are really hot and then they kind of faded. I think with AI coming out, it's really hurting these businesses because you can learn a lot from AI and on YouTube and so forth. These guys are a company headquartered in San Francisco. Okay, let's take a look at their growth and see what they're doing. So this is a tiny cap, 972 million. Revenue is 790. So you see the valuation is not very good. You're paying less than 2 times sales. So the market's not buying these stocks a whole lot. It's sold off over the 1 year. It's really sold off over the 5. And yeah, coming out of COVID, these things were really hot because during the COVID shutdowns, it seemed like, man, this type of learning on platforms is here to stay. And it was, but now they're competing with like AI and other forms of learning and information gathering. So it's made it tough on these businesses. They are growing. They're growing by a decent amount, 5%. So that looks good. They're producing cash flow, decent gross margin. This one here, I mean, could be a slow mover, a slow gainer, but I just don't think this one's going to make a lot of money. What would cause them to make a lot of money? I just don't. I don't see that happening. I think the whole learning is going to go to one of these AI platforms where you can basically talk to AI now or converse with it, and it could be your super mentor, where you go to your AI application and it mentors you on whatever subject you want to learn, calculus, you want to learn biology, you want to learn something. I think AI is really going to fill in that need. So this one here it would be a non-starter for me. And I think somebody asked about RCAT. So Red Cat Holdings, what does these guys do? Together with subs, provides products and solutions to drone industry. Okay. Well, drones are pretty hot right now because there's an increase in defense spending, especially in Europe, where they're going to build out their armed forces. So let's take a look and see what this company is all about. Year to date, this one is not flourishing. Over the 1 year, it is 521%. Wow, incredible. This company was kind of not really being counted in. It was kind of being counted out because it was under $1 per share, which means investors just didn't want to buy the stock. And it's risen to $8.57. So that's the big gain. Their market cap is under $1 billion. Really small revenue. $2 million of revenue. That's nothing. That's like really low. And they're losing a lot of money. So this one here, no thank you. They are not, they're not selling much. And they've been around for a while. And the drone industry is doing really well. So this one here has it been catching a rally lately, or what caused you to bring this one up? It's just a question. It's not like calling you out or anything. So this one is up 26% one day. So it really went up. What was the news that caused it to go up? So I get that, revenue can go up for this company. It went up a lot. Are they going to be acquired, or what's the story? But when you look at the fundamentals, it's like, so their revenue is going to increase from 2 million to 3 million. Whoa, wow. It's like, come on. It's like tiny company. So I'd be careful. This one can end up being valued at zero, or it could go up. I think there's too much chance for it to go to zero, and it's going to bump along the bottom. It's going to catch these days where a bit of news is going to make it fly up, like here. But for the most part, the market's like wow, probably looking at this data going, why would I invest in this? This is a very a business that looks like it's going out of business. It's not going to stay in business. You don't go down in revenue when you're this little. If you have a good product, your revenue should be expanding. It should expand quite fast, especially in a market where you have like drones. Drones are pretty hot right now. So yeah, this one's a pass. Two passes, man. Keep bringing more stock tickers, guys. I don't like having so much negativity in my life. I'd like to say a couple like, man, this stock looks awesome. Saeed. All right, so let's take a look at this one. What are the grounds Wells Fargo downgraded Oscar? Let's take a look. Let's kind of do a deep dive on Oscar. All right, so Oscar Health. A lot of you guys know who they are. They do health insurance for individuals and small businesses. So you have some investors saying, hey, I'm buying into this dip, and the stock is struggling over the last month or so. It was at $21 a share, down to 14. Now, there's a couple of reasons that I'm seeing. Now, I'm an Oscar stockholder, and I've been buying into the stock. Now, if you want volatility in your life, I have the right stock for you. You will ride the roller coaster up like 55%, and then that same roller coaster will dive down 33% and up and down, up and down, up and down. But the big picture behind Oscar is quite positive. They're going after a particular area of the market where the big guys, the United Health and the Elevances, they don't want to touch the individual nor the small business. But Oscar does. And now with the advent of like AI and a lot of business processes being automated through machine learning and so forth, Oscar stands to really capture a big part of the market and continue to grow. And when we look at their fundamentals, they are just really, really growing. See, like we saw that drone company, they're a $2 million company. It's like, guys, these guys were small and they kept growing. Now they're big. They're 10 billion in premiums, total revenue, $10 billion. That's what you're supposed to do. And then you catch the market's attention. If these guys keep growing at these rates, they're going to be a $50 billion revenue company, $100 billion. And this stock's going to be a 5x, reward or a 10x reward for me. So the big picture, I'm completely bought in on Oscar. Now, some of these analysts, and let's see if we can find where some of this negativity is coming from. So we have 6 analysts covering the stock. Let's see if we can find that Wells Fargo analyst. Some analysts are quite optimistic, and there is some pessimistic analysts. I think there is something out there. Here it is. So this guy downgraded it. And look at this here, okay? So his credibility, if he had all 5 stars, all nice and gold, that would mean a little bit more. Now, I don't follow these analysts all that close. Why? Analysts are constantly making these opinions, and it's not an opinion where it's like, let's say they made an opinion where they're like, hey, this is a really good company and this is a stock really worth buying. Okay, how much stock did you buy? Because why would you arrive at that conclusion without buying it or selling it? Okay. So they're just forming opinions and putting it out there. And they tend to be really motivated by a couple of things is, what are other analysts saying? What's the vibe or the overall opinion on that industry in that company? So I wouldn't pay too much attention to what analysts are saying. I think when you look at their consensus, I think the consensus is something of interest to me. The consensus is that these guys are going to continue to grow in 2025, 25%. They're going to flatten out, and then they're going to grow again at 15%. So they're going to be a $13 billion revenue company in 2027. That's looking really good. They're going to expand their profit big time. Look at that expansion of profit. So they're going to be far more profitable in the future, and their PE is going to drop to 8 in the future. High growth company with a PE of 8. Oh man, that's going to be awesome. So back to the investing, what's the thesis? What's the story? Okay, how can Oscar go from being worth $3.6 billion to $36 billion? And then at that point, we multiplied our money times 10. We took our $10,000 and turned it into 100,000. And the story is if they keep growing and they keep amassing that revenue and they keep increasing the free cash flow that they're producing, they keep increasing the profits in proportion to their revenue growth, there's no way around it. These guys are going to be worth a lot more, period. The story generally that is bringing down healthcare stocks is the big, beautiful bill that got completed in Washington. The big, beautiful bill is going to take away some benefits to some citizens in the US. Some of these benefits are going to take away, volumes of pharmaceuticals that are being bought. It's going to make it a little harder for insurance companies to cover citizens that don't have a lot of money. And I think that the insurance payers will have to figure out how do they work around those new laws or the limitations of funding. But the best companies are going to figure it out. Health insurance is a massive need. When you look at the GDP in the United States, 20% of it goes to healthcare. 20. It's bigger than military spend. It's massive. So when you're going to cut back some, I get it. It's a cutback. But you still are dealing with a humongous addressable market. So I'm not overly concerned with that. I'm actually buying into Oscar Health day after day. When I see these drops, I buy more shares. This is going to be one of the stocks that are going to be, and I'm going to go with Robinhood. So Robinhood had this chart, right? And I'm not a big technical analyst. You guys know that. My good friend Daryl is. If Daryl is on the stream, boy, he could take us through this and really, really come out with some good stuff. Or Trader Pratt, he's really good at this. But just generally, the market said Robinhood is terrible, and there was good reason. In 2022, we had a bear market, and retail investors were not all that enthusiastic. They kept seeing their investments go down in value, and they're like, oh man, I hate investing. I hate it. I hate it. I hate it. Bitcoin was losing value. A lot of things were bad. Well, in my mind, Robinhood had a unique story, which is they're not creating a trading platform that is kind of like E-Trade or Charles Schwab, just does it better. No, no, we're not even starting there. We're starting completely with a new experience for retail investors. And over again, they continue to double down on being overly unique and super innovative. And I believed in that story. Their fundamentals were good. If you look at the Robinhood fundamentals, they had free cash flow. They've had free cash flow for a long time. So if you focus on the fact that, hey, they have a unique proposition in the market and they are growing. Now they had that bad year, right? Because traders were really disappointed with the losses and oh, I'm not going to buy any more stocks. But you see the growth in 21, you see the revenue growth in 23, 58, 59. They've made themselves a $3.2 billion revenue company. And these are services. Their margins on services for financial services is really good. Let's see if I can find that profit. So their profit on their business is 48.7. Oh, that's net profit. Who wouldn't want a business like that? You're done paying for everything. You paid for the accountants. You paid for everything. And you got 48% profit left. Awesome. And you could see that coming because what I did is I analyzed the financials and projected out, how are they going to start generating profit margins? And once the market realized it, the stock took off. Okay. But I understood like the addressable market they were going after and their profitability. It's the same observation I have generally on Oscar is they have plenty of addressable market, huge market. They can continue to grow at these rates for a while. Nobody's really standing in their way. There's no big company that's saying we're going to take on Oscar Health and battle them for this part of the market. So I think they're going to continue to grab land or a big land grab, so to speak, from a market share perspective. And what they need to focus on is just continue to grow that top line, make yourself more efficient using AI and so forth, and increase these profit margins and increase this free cash flow margin. If they increase their free cash flow margin just by like 2 percentage points, like right now, they're discounted. But if they continue to expand free cash flow margins, there's no way around it. These guys are going to be worth a lot of money. Their free cash flow, they cash flow over $1 billion in free cash flow. Their market cap is 3.66 billion. They're producing more than 20% of their market cap in free cash per year. That's excellent. That's very high. And if they keep getting bigger and they keep making that free cash flow bigger, there's no way around it. They're either going to be acquired or they're going to be worth 30, 40, 50 billion dollars in the next 5 years. And they're going to 5x, 10x our money. Robinhood has taken my money and multiplied it times 6 in about 2.5 years. That's the best percentage stock that I've had in the last 2.5 years. I would like Oscar to do something similar. I believe they have a chance of doing that. So that's one of the stocks that I think it's a small cap. Right now, healthcare is getting beat up. It's because that big, beautiful bill. There's things in it that basically stipulate that they're going to reduce benefits to a lot of people. And I think that's going to take out dollars from that economy. And let me just remind everybody, that economy is 20% of GDP for the United States of America. It's massive. If Oscar can outmaneuver and outperform its competitors, it's going to have plenty of addressable market. It's going to be able to really take on more profitability and more free cash flow. And just to finish things off, let's take a look at my evaluation of Oscar. And of course, Saeed, you're a member of the channel, so you can view this at any time. On the shared folder for paid investors, you can look at my research and you can get to this sheet. The sheet is available. You just hit Control F. You put in the stock ticker, Oscar. It takes you down to Oscar. And I think did I type this wrong? There we go. It'll take you over to Oscar Health, and then you're looking at the research. Now this is a small cap, so I go with a higher discount rate. Now if we see interest rates go down, small caps are going to go up in value, by the way. And I expect that interest rates are going to go down. There's no way around it. President Trump wants lower rates. He's going to replace the the Federal Reserve chairman next year, and he's going to hire somebody that commits to lowering interest rates. So long-term interest rates are on their way down. Overall, I think the stock is discounted by 57%. It's just there's a lot of pieces to Oscar that make it valuable. They also have a CEO that comes from the industry. He knows how to run a large-scale health insurance payer. He ran Cigna, and then Cigna was acquired by CBS. So he has the right experience. They have the right business. We just have to be patient because the big, beautiful bill is creating a lot of negative stories and expectations for the healthcare industry. And it doesn't help that right now technology stocks are just flying up. Financial stocks are flying up. And it's taking all the dollars away from healthcare. There's very little inflow of investment into healthcare at this time. But maybe in a year's time, this is going to start flourishing again, and we'll see this thing pay off. So those are my comments on Oscar. Thanks for asking, Saeed. I think I'm caught up on comments. Yeah, I think so. We covered RCAT. Yeah, keep the questions coming, guys. We principally talk about stocks on this, channel and on streams. But today we're going to talk about these super investors. It's now time to talk about, go down the list and talk about some others. All right, so let's take a peek at Tom Lee. He's number 2, and he was number 1 up until I updated Vinall's. And he he has a portfolio, the Granny Shots portfolio, and he publishes this information on his website. So I was able to update it. And they use big models, and they go after what they feel are logical, investments they should be making. So you see them making, and I'm going to come down. So this is what they owned in the first quarter up here, and then where it starts here in column L. This is what they owned in the second quarter. And his number 1 stock is Robinhood. So I just talked about Robinhood. So he just killed it with Robinhood. Oracle made a lot of money. AMD. Where's Mike, the dividend investor guy? He's an AMD guy. He's been telling me AMD's gonna kill it. I don't quite see it, which is okay. Sometimes, we don't have to all invest in the same stocks. But AMD proved to be a good winner. And it looks like NVIDIA, definitely big winner. GE. So he's really been cleaning up. A couple of stocks didn't do well. Garmin, not sure why they're in Garmin. That's old tech. Abbott. Apple. Nice job there. That is not a granny shot. That's a bad investment. Progressive is down. Yeah, insurance. Fair Isaac. Are we going to need FICO scores, or AI going to do that for us? I think AI is going to do that for us. So Fair Isaac may be out of business. Now, the reason why he's not just completely killing it is that in the first quarter, he owned, or he had the fund owning a lot of stocks that underperformed. One of them is AMD. Another one, Tesla, underperformed. Arista Networks underperformed. So those obviously are held him back. Second quarter, he's killing it. And that is Tom Lee. I did a video on Tom Lee, so you can take a peek at that if you want more details. I'm going to keep going down the list down to Michael Burry, and then we're going to hit Carl Icahn. So Burry makes it easy. He's like, you know what? I made good money in Q1. I'm a very respected investor. And then he got out of all stocks except Estee Lauder. He stayed in Estee Lauder. So, and look, it's turning around. Good job. He's making money on Estee Lauder, but he sold everything else. He was in a really good position of Alibaba. He made good money in Q1, and I have to say that was a good move. He sold in the first quarter. Alibaba did really well, and then the second quarter hasn't done well. It was like awesome first quarter, not an awesome second quarter. So he made a good move there. And he had a lot of Chinese stocks and healthcare, and he got out of both. So it looks like he knew what he was doing in doing so. So that's Michael Burry. He's in third place, and he's willing to get in and get out of stocks. Just big moves. Really interesting. Obviously, he shorted the subprime market back in 2008, 2009. and became a legend. Now let's talk about Carl Icahn. This is the corporate raider. This gentleman is 88 years old. He's not quite as old as um, Warren Buffett, but he's up there, and he's not afraid to mix it up and fight against other investors. So let's take a look at what he's been up to. Now, Carl Icahn, um, his biggest win is CRB Energy. And some of these utilities have just really, really gone up in value, which has been incredible. He's made almost $1 billion from CRV Energy. That's his best investment. Look at that. Just year to date for the first half, he was up 72%. And then for the days in July, this stock continues to fly up. So that's his best investment. Nicely done, Mr. Icahn. Another good investment is Dana Incorporated. I think they're an industrial. They do like truck axles and equipment components for heavy machinery, heavy trucks. And we've got UAN, which is part of CBR Partners. Okay. And the last one I'll note is American Electric Power, another utility. Nicely done. Now he's making a big, gigantic bet on JetBlue. Look at that. He added 89% to his position, and he's betting about $76 million in JetBlue. That's a pretty big position. So far, it's not paying off. Now, Delta did announce that, like Delta announced last week, and their stock really went up. So I imagine JetBlue stock went up, but JetBlue is not Delta. Delta is kind of a blue chip stock. JetBlue is one of the new airlines, and I don't think they're as well capitalized as Delta or United Airlines. But he's making a big bet there. Interesting. I think this one's going to either make him or break him going forward. He's also increased Illumina. This is biotech. Illumina is a biotech healthcare company, and it's working in the second quarter, but it didn't work for the first quarter, and that's looking pretty good. But overall, he's got almost a 17% rate of return. That's really good. That's really good for Mr. Icahn. And the interesting move is that investment into an airline. He's also expanded international flavors and fragrances. This is probably a company that adds or is a food company by selling these flavors to food companies that are then going to use them. And his biggest, impressive move was this, utility. So taking a closer look at Carl Icahn, this is his website. Not the nicest website we've ever seen, just very informational. And this is Wall Street Journal trying to sell me a subscription. This is Carl Icahn. He's up there. He's about close to 90 years old, and he's still mixing it up. He's still getting out there. He is a self-made man. He's worth, I think, over $21 billion. So nicely done, sir. He grew up, I believe, in Queens, New York, and is now a legend. Nicely done, sir. So I know that he could be like Kathy Wood, kind of the target of a lot of like negative sayings and expressions, and a lot of Wall Street elites don't like him, but he is who he is. He makes no apologies. He's willing to fight against other investors, and he's been an interesting guy to follow. He's also, back in the 80s, he was a corporate raider. What they would do is they would buy companies because they thought the assets were better. They'd buy a company and then sell it off in pieces. And it was painful for the companies, but he made a lot of money. And it wasn't all that popular because a lot of people lost their jobs and stuff. But some of these companies were just bloated. They weren't really after profitability. They weren't intensely trying to grow. They were just kind of like happy, hey, we got this really cool company. We're just going to sit back and treat it like a government entity. And in the 80s, a lot of companies got torn up because they were really susceptible to it. They had really valuable assets. They weren't driving enough return on assets. And guys like Carl Icahn were coming up, buying them up, and then selling them off in pieces. That stopped for a couple of reasons. One was it wasn't, very popular. Second is there was certain opportunities, and then businesses wised up. They're like, well, we better start doing a better return on investment, or that's going to happen to us. And a lot of acquisitions happened too. So that was an interesting time in the investing world, and Carl Icahn was a legend in those times. But for now, he is ranked number 4. So that is the 4th ranked investor. David Tepper's next. He's got a long portfolio, a lot of tech, and then Kathy Wood. And that's where I think I'm going to stop there. I don't want to kill you guys with too much super investor data and return back to the chat. All right. Shadow Guy, you were at AMD. Nicely done. Man, you guys are making all that money on AMD. But I just don't see the cash flow. So I'm going to stick to my process. You guys stick to yours. And you guys keep making money. Year to date's up 21%. It's very good. And this rise from $78 a share to 146. Wow, that's a terrific ride. So year to date, if you go from the very low point to where they're at now, the stock's up 87%. Wow, what a great ride. AMD is doing some good things. They're advancing their technology so they could sell into this whole AI build out better. And who knows, maybe at some point they'll be more competitive with NVIDIA. What's interesting about AMD is, before NVIDIA, AMD would always try to kind of catch up to Intel, and they never quite could. They'd always be battling to be relevant and competitive with Intel. And it just seemed that like they never got close. And now they're doing the same thing with NVIDIA. So we'll see if they get close on this occasion, or if it's just going to be they're destined to always be a laggard, not the top dog in a particular technology market. But the stock's working. Congratulations. Glad it's working for you guys, and for you and Mike, the dividend investor guy. So, all right, cool. Well, that was a fun stream, guys. I appreciate the questions. Appreciate you guys tuning in. I'll create a couple videos just highlighting Icon and highlighting Vinall. Probably release those over the next couple business days. But this week, I'm really going to focus on the earnings that are coming up, because earnings are what are going to move the markets big time. We got Monday coming up. We got a small, industrial company, Fastenal. They won't move the market. I don't even know if I'm going to pay attention to this one. On Tuesday, this is market moving information. So before the market opens, you have all these big banks announcing, and this is going to move the market, especially financial stocks. I'm expecting the banks are going to have a lot of good things, a lot of positive things to announce, and some of these stocks are really going to go up. And it's probably just going to put a little bit of an enthusiastic step in investors' minds, is that, hey, if the banks are doing well, that means the economy is probably doing well. So that's probably going to keep this rally going. That's my expectation. Of course, the opposite can happen, but I'll just share with you what I think is going to happen. And I'll be tuning in. I think it'll be an early morning on Tuesday. These companies, luckily, they're all headquartered on the East Coast. They'll release their financials probably around 8 in the morning Eastern. So it gives us an hour before the market opens to analyze the stocks. I'll prioritize based on the stock that I own is Citigroup. So I'm going to focus on Citigroup and then JP Morgan, Wells Fargo. Then I'll rank the different banks against one another, book value being one of the key metrics that I look at with banks. And we'll see where these banks are going to land and see how high their stocks go or if their stocks are going to sell off. After Tuesday, on Wednesday, we have Johnson & Johnson, a healthcare stock. Healthcare is not catching much attention, not much of a rally. Bank of America, ASML. Now, ASML would be interesting because NVIDIA is flourishing, Broadcom's flourishing, AMD is flourishing. And ASML builds the equipment that semiconductor needs to create semiconductors. So that earnings will be interesting to follow. I'll definitely take a look at that earnings and see what they have to say. Progressive Insurance is going to announce on Wednesday, and a lot of companies are announcing. United Airlines, so that will be announcing on Wednesday. Thursday, Netflix, we'll see what kind of subscriber growth they had, revenue growth. I think they're overpriced, but that's just me. I owned Netflix. I made good money on it, and I sold it. We'll see what they have to say on Thursday. General Electric, these guys have been just flourishing. Their stock price has gone up so much because of the ability to manufacture power generation equipment, turbines, and power generating equipment. And so there's just a lot of companies, too many to name. And then on Friday, American Express, Charles Schwab, 3M, man, Schlumberger, you name it, Ali Financial. And it doesn't stop there. On Monday, a week from this Monday, it just keeps going. And it's going to get even bigger. Alphabet in a week and a half. Tesla, T-Mobile, geez, it's going to be huge, humongous. And that is followed by Blackstone, Unilever, Union Pacific, and Tuesday, SAP. So we just have so much earnings to cover over the next month and a half, and it will move the markets. And it's a little too late to make big moves, in my opinion. But Google's announcing in a week and a half. I continue to buy into that stock. I just think they're really being counted out when I think they're a great company. But we'll see. All right. Well, if there's no other requests on tickers, I want to wish you guys a nice weekend, and I will probably wait to stream on either Monday evening or Tuesday morning. I'm going to try to stream a couple of times with Daryl, who does technical analysis really, really well, and I'll do the fundamental analysis. We'll go over a lot of these earnings together. Probably send out the notifications on when I'm going to stream again, and hopefully you can attend at that time. So thanks so much for tuning in. I appreciate it. And everybody enjoy the rest of your weekend. Take care.